Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last two lectures, we mastered the math of market entry. We covered the contrarian left side and the momentum-driven right side. But today, we tackle the most critical phase of your entire trading system, the exit. Investing is ultimately about realizing real profits. Staring at the illusion of paper gains does not build wealth. Taking profit is a defensive mechanism to protect your capital from the market's inevitable mean reversions. Today, we're going to look at exactly how to structure your exits. Whether you are a long-term value investor or a short-term value price speculator. Let's start with strategy 1, value investing. As a value investor, your exit strategy is anchored directly to the valuation matrix we built in section 1.7. You don't exit because a moving average occurs. You exit because the mathematical gravity has shifted. Especially, we use the aggressive position overlay. When a stock surges 20% to 30% above the absolute ceiling of your range 2 expected target, the fundamental risk becomes overwhelming. For example, if our matrix defines Nvidia's range 2 ceiling at $235.2 and the market you feel drives the price up to $300, the stock is trading at nearly a 30% premium to its fundamental reality. A disciplined value investor must strongly consider reducing their position in this premium zone, securing that massive profit, and waiting for the fundamental correction. But what if you are executing strategy 2, 3, or 4? If you are a trend or swing trader, fundamental ceilings are secondary. You are trading price action. For this, static targets like saying I will sell when I'm up 20% are highly inefficient. They cut massive winners short. Instead, quantitative traders use dynamic targets, specifically the trailing stop loss. As we covered extensively in our order mechanics lecture, a trailing stop automatically adjusts with the market trend. If the stock goes up, your stop loss moves up behind it, but it never moves down. Because we already know how to enter the order on the platform, today we are focusing purely on the strategy. Where exactly do we place it on the chart? The difference between an amateur and a professional is knowing where to place that stop. We do not guess, we calculate. First, we use this R over 5 rule below technical support. If you have an unrealized profit of R%, a rough quantitative heuristic is to place your stop loss approximately R over 5% below the nearest structural support line. So, if you are sitting on a 20% profit, you divide by 5 to get a 4% buffer. You place your stop 4% below that support line to absorb normal intraday volatility without being prematurely stopped out. Keep in mind, this is a rough guideline, not a rigid law, and should be adjusted for higher volatile stocks. However, there's a special case, euphoria, If a stock gaps up parabolically without establishing new structural support, the R over 5 rule fails. In this environment, you abandon structural support entirely and place a tight, straight 5% trailing stop right behind the current price. Finally, you can anchor your stop to valuation boundaries. For stocks flying far above their estimated fair value, you can lock in that over valuation premium dynamically. You anchor your minimum stop loss level exactly at the upper bound of your current range 2 selling. If the price crashes back through that fundamental ceiling, your position is automatically closed. To execute this dynamic axis accurately, price-driven traders rely on structural analysis to signal exactly when momentum is failing. They look for structural breaks, like a price decisively branching a critical ascending trend line. They watch for candlestick and volume patterns that signal exhaustion. And they look for composite signals, like momentum divergence using oscillators such as RSI or MACD. Now, none of these execution methods are perfect. Each has distinct strength and weakness. But do not worry if these terms sound completely foreign to you right now. You will learn all of these relevant techniques, indicators, and structural terms in our upcoming chapters on technical analysis. Now, let's address the elephant in the room. You know the math, but many of you will still hesitate to use a trailing stop. Why? Because you fear the stock will hit your stop, sell your shares, and then immediately skyrocket, causing your regret. This is a behavioral finance flaw known as loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, human beings react much more violently to losses than to gains. The data shows that the negative emotional impact of losing capital is about 1.5 to 2.5 times more powerful than the joy of making the exact same amount. Losing $100 feels like losing $250. A trailing stop loss is not just a risk tool. It is a psychological shield. It neutralizes loss aversion. It acts as an emotionless circuit breaker, preventing a profitable right side trend from turning into a devastating left side trap. That wraps up section 1.8. We now have a complete end-to-end quantitative system for analyzing, buying, and selling individual stocks. But what if you want to apply these principles to the broader market? In our next lecture, section 1.9, we're going to zoom out. We will introduce key ETFs, break down the S&P 500 and its sector compositions, and discuss how to select the right macro vehicles for your portfolio. As always, if you want to see me apply valuation boundaries to live companies, check out the individual stock analysis playlist on the channel. Thank you for joining me in the Quant Lab, and I will see you in the next lecture.